Welcome back. Value investors from around the world are gathering here in New York today to talk about investment ideas and strategies at the 5th Annual Value Investing Congress. Our John Ehrlichman joins us live from the conference with one of the kings of value investing. John?
Yeah, you're right about that, Mark. And obviously, a lot of people are wondering what's next for stocks after the big run-up we've seen. Where do you look for value out there? We want to ask Joel Greenblatt of Gotham Capital. Joel, thank you for your time. You just wrapped up your conversation with the audience here, and I'm curious to know, after this big run-up we've seen in stocks, where do you look for value right now?
Well, you know, what I talked about was really buying a portfolio of stocks that we thought were cheap on a statistical basis and also get good returns on capital, meaning good quality companies.
Return on capital is something, I mean, you're a big fan of that.
Right. In other words,
using their cash.
Right. In other words, if a company can earn 50% on its capital, that's better than earning 2% on its capital. So basically, you know, what I was talking about was just doing a ranking of stocks based on how good a return on capital they get and how cheap you can buy them, and taking that combination and buying a group of those. So there's always stocks in whatever market. There's stocks that rank highest in those two categories.
When you do those searches right now, are there sectors that pop up? A lot of people talk about healthcare or energy as groups that have lagged the rest of the market. Is there specific sectors that really stand out for you?
Well, in the last week or so, there's construction and engineering because people don't think that the future will look as bright as it has looking backwards. And so they come up as cheap. There's some consumer discretionary that comes up as cheap. There's some oil field service companies that come up cheap. So a lot of companies that, you know, sort of had a good past record, but you know, the future is questionable. Maybe some pharmaceuticals where they're worried about health care, you know, things of that nature. Stocks that have a question about them, you can sometimes buy very cheap and maybe too cheap.
What's the concern after the run-up that we've seen in so many stocks? When you screen on a list for value and you find your names and then you say whether or not we should actually invest in these, what's the next thing? You like to look at earnings yield, for example, something.
Right. So it's a great question, and I'm really not good at predicting where the market is going. But, you know, we did a study over the last 10 years where the market was down 2%, you know, a pretty crummy 10 years for the market. Following just this systematic computer-driven strategy, the portfolios we put together were almost quadrupled during that same period. So where the market goes is not the whole question. It's really what you buy.
You mentioned return on capital. A lot of companies have been conserving their cash, possibly use it for deals. Others pared back their dividends. Is that something as a value investor you want to see? Companies that cut their dividends, reinstate those dividends?
Really, when I look at return on capital, what I'm really looking for is, you know, a company uses working capital and it uses fixed assets. How well does the company use those? In other words, how much do they earn when they spend money and buy plant and equipment or invest in working capital? And if they get very high returns on that, that's something that I'm looking for. It's really not how much they cut their dividend or how they conserve their cash. It's how much they earn on their assets that they have to invest in their business. So if you have a store that earns, you open a new store and it earns 50% return on capital, you view that as good.
Let's talk about a macro theme. David Einhorn of Greenblatt Capital was talking earlier about inflation and how that potentially hurts or collapses price-to-earnings ratios. Do you have to look at that macro theme and say, if inflation is something that you are concerned about, that's going to hurt, say, valuations on stocks?
Well, it may well, but there's also very few places to protect yourself from inflation. And so if you find companies that can raise their prices along with inflation, they have pricing power, then that is potentially one protection. And people make that argument that stocks are a good protection against inflation over time.
All right, Joel, we really appreciate your time. That's Joel Greenblatt joining us here at the Value Investing Congress. Mark, I want to send it back to you.
John, thanks.